Hi, David. Thank you very much for joining us today. Gold Royalty went public 2 years ago with 18 royalties, and now you have over 200, 8 of which are producing. But I want to focus on 3 key assets which will be driving growth in the near term. And I want to start with Canadian Malartic, which is Canada's largest gold producer. The asset which you have the royalty on is the Odyssey mine, which is the underground mine. Can you provide an overview of this asset, where it is in terms of its production profile and what it will mean to Gold Royalty when in full production?
Well, there's a couple of unique aspects to that, very, very positive potential for that asset, in that obviously Agnico's now consolidated ownership, and there are going to be some synergies realized by doing that with the rest of the assets along that district that I know extremely well. I spent 12 years of my career at Agnico Eagle as we were building that district out, including LaRonde, Goldex, Lapa, and the like. So I think that's encouraging, and they're likely to amplify their exploration efforts. So that'll help realize the geological potential at depth, particularly as they gain access for production. As they put that underground infrastructure in for production, they're also going to get better setups for exploration drilling. I have every confidence that that resource will balloon over time, even though it is substantial and supports 20 plus years of reserve life ahead of it. I think it has potential to grow for the foreseeable future. And you're right, we have an NSR, 3% NSR over more than half of the underground resource at Odyssey. We have a limited royalty as well on the open pit. We're actually generating revenue today from Canadian Malartic, but we have substantially better coverage on the Odyssey underground. But the other aspect of that deposit, and I'm sure you're going to pop up a slide later on that shows our royalty coverage along the contiguous properties around Odyssey and Canadian Malartic in particular, is they're going to have a lot of spare capacity in the mill. They're currently milling 60,000 tons a day from the open pit, but as they go underground exclusively over the next couple of years, they're going to go down to about 18,000 tons a day. That's over 40,000 tons per day of spare capacity in that mill. So it's become an economic imperative for Agnico to look for satellite deposits along contiguous land positions there, upon which we have substantial royalty coverage. So we're quite confident that over time, as they ramp up their exploration efforts to start to look for more sources of ore for that mill, we're going to get better royalty coverage over time.
And when in full production, what will be the annual production at Odyssey?
So it's going to be, it's about 500,000 ounces now at Canadian Malartic. It'll actually be 500,000 ounces when it gets the full ramp up of the underground, because it's substantially higher grade, even though it's much lower tonnage. But our royalty coverage is substantially higher. As I said, at least half of the deposit or half of the production will be subject to our 3% NSR. So you're going to see a significant wrap up in our cash flows over the coming years as Odyssey comes on. You pointed to some of our other cornerstone assets, but those are driving 60% compounded annual growth in our revenue across our entire portfolio, right through to the end of the decade, driven by Odyssey, driven by Cote, and driven by Ren, which is the underground extension of the Nevada Gold Mines Gold Strike deposit.
Hey, David, you just mentioned Cote. I want to touch on this one now. That is the IAM Gold Mine, which is located in Ontario. This mine has been plagued with many issues, but when in production, it will become Canada's second largest gold producer. Can you just give us an update on what's happening at Cote, and including when it will go into production? And when it does, what will that mean to Gold Royalty?
Sure. Well, it's 80% constructed as per the disclosure that IAM Gold just put out with their recent quarterly results. So they're well advanced. They've done an exceptional job of recapitalizing the balance sheet to deal with what was astronomical cost overruns. You know, they've been plagued by inflation that really the whole mining sector has been plagued by. I think that's why valuations are so depressed these days in the mining space, in spite of the fact that gold is near all-time nominal highs at $2,000 an ounce. But that's the beauty of the royalty model, is we were completely insulated from that. Our exposure is entirely top line. We have a royalty on the highest grade portion of the open pit, Zone 5, that we mined early on in the mine life. Our payback is very, very rapid on our $16 million investment on the acquisition of that royalty from a third-party prospector.
Your third asset, which will provide significant cash flow when in production, is the Ren Project, which is the underground extension at the Gold Strike mine in Nevada. What stage is this project in, and when will it start contributing to cash flow?
Yeah, so Ren has already published an inaugural resource of Barrick as operator of nearly 2 million ounces at over 7 gram a ton material. So over 7 times the grade they're mining from the open pit, easily accessible from existing infrastructure. And of course, close to all of that surface infrastructure, the processing facilities that have been built out over many decades of operation at Goldstrike. Given the grade being so high relative to what they're mining from the open pit, Barrick has said that they're likely to prioritize this into the mine plan quite shortly. And also they see 3 to 5 million ounces of potential there at that deposit. And they're looking at a production profile from the underground of about 150 to 200,000 ounces per year. And we have entire royalty, exclusive royalty coverage on that deposit through both an NPI and an NSR.
David, one of the features which makes Gold Royalty unique is that you have a royalty generator model, and this is where the Ren royalty came from. Can you just expand on this model and how it works and how it benefits Gold Royalty?
Sure. In the course of acquiring Golden Valley, Abitibi, and Ely Gold over the course of 2021, we also curated some very capable people. We kept all of the principals from those companies on board. In the case of Ely, Jerry Baughman and Trey Wasser, the co-founders of Ely, continue to stay with the company. Trey is on the advisory board. Jerry runs our business in the U.S. in Reno, Nevada. And Jerry, many people know in the mining business, has been a prospector in Nevada for over 35 years. And he stakes exploration claims around existing mines, deposits, and then he waits for the neighbors to knock on the door, and then he farms the properties out and takes a royalty and option payments back and work commitments back. Similarly, Glenn Mullen, the founder of Golden Valley and Abitibi Royalties, stayed on our board, and he runs a small part of our business in Val-d'Or, Quebec, doing exactly the same thing that Jerry does, and coincidentally has a similar experience level to Jerry, over 35 years of prospecting in Quebec and Ontario. So both Glenn and Jerry bring an element to our business model that didn't exist prior to the acquisition of those companies. It complements our capital markets expertise, our M&A expertise on our board of management, and our mine building expertise with good old-fashioned prospecting, where, again, they stake exploration claims and farm the properties out and take royalties back. We typically generate about 2 to 3 royalties per quarter doing just that. And it costs us nothing other than the sweat equity of Jerry and Trey and Glenn, effectively doing that work on the ground. They're collecting a salary anyways. They're keeping their ear to the ground. That gives us access to opportunities that perhaps some of our competitors aren't aware of, because we have that kind of human footprint on the ground, but also it generates royalties very, very cheaply, effectively just the cost of their efforts. And as you can imagine, we don't need a lot of those to hit to generate infinite rates of return, because the cost of entry is effectively zero.
So you mentioned that you're doing 2 to 3 royalties a quarter under this method. How many have you done in total?
About 60 so far. So out of the 222 royalties we have in the portfolio, 60 were generated organically through that model, either within Gold Royalty or in our predecessor companies, Golden Valley, Ely, and Abitibi Royalties. So they were generated very, very cheaply, very cost effectively, and it introduced all sorts of optionality into our portfolio. And the great thing about our royalty model and anything in our royalty portfolio is we own them outright. They don't have any capital calls. They're perpetual assets, infinite optionality. We can just be patient and wait for our operating partners to deliver on the potential of those deposits.
David, we spent some time talking about your 3 cornerstone assets, Malartic, Cote, and Ren. And I'm just wondering, you have a very large portfolio, but is there another Explorco or development project in there that you think holds a lot of promise?
Well, there's at least a couple. And, ones that we like to point out is we're really encouraged to see Orla take over Gold Standard Ventures. We have a royalty on Railroad Pinion, and it looks like Orla is going to fast track that into development in fairly short order. And they certainly have the capital available and the technical expertise given their success with Camino Rojo in Mexico. So very, very confident that that's now landed in the hands of a very capable operator. Similarly, Wallbridge owns the Fenelon project along the Detour district on the Quebec side of the border, really just a few short kilometers away from the existing Detour complex that Agnico Eagle owns. And Wallbridge now is 10% owned by Agnico Eagle, but also has an executive chairman in Tony McCush, the former CEO of Agnico Eagle. And I think we've seen Tony's track record over the last several vehicles he's run. He gets them to a point where it becomes very attractive and compelling for an existing operator to tuck in. And so I have every confidence that as he delivers on that 4.5 million ounce PEA study over the course of the next month or so, he's really teeing this up to be wrapped into a much larger operator with a bigger balance sheet and the technical capacity to bring it forward into production. But it's obvious, given its proximity to the existing complex at Detour, that that's an obvious tuck-in for Agnico Eagle potentially in time. Again, a very large deposit, high grade, in a district that's well built out, really brownfield in nature. We see a lot of potential there, and we have an exclusive royalty on that property as well.
David, I want to move on now and discuss your balance sheet. A large part of your strategy is growth through acquisition. What is your liquidity position right now, and how will you fund acquisitions going forward?
Well, we're very conservatively capitalized. We have virtually no debt on the balance sheet. We have a line of credit of $35 million with Bank of Montreal and National Bank. We've drawn on less than 10 million of that. So against a market cap of 300 million, very, very little debt on the balance sheet. And that's by design. We want to be conservatively capitalized. We do pay a dividend. We have about a 2% yield at current share prices. And given the growth that we see in revenue and the fact that our G&A costs are extremely flat, stable, we spend about $6 million on G&A costs, really largely on public company costs, D&O insurance, listing costs, and the like. We only have 8 employees, and we could run a business 10 times the size with the same human footprint. So as you can imagine, every incremental dollar of revenue falls right to the bottom line and increases our potential to pay increasing dividends over time. So we have plenty of free cash. We actually tip into free cash flow next year. And that's remarkable for a company that's only 2 years old, that we've got from startup, really a blank sheet of paper a little over 2 years ago, to free cash flow within 3 years, paying a dividend 10 months after our IPO. So we've been able to demonstrate through the success of our IPO and through the success of our M&A strategy that we can access capital quite readily. And really, we've built a company that's that's scalable. Scalable in terms of the people we have, but also we've been careful to put in the building blocks for a sustainable business, including publishing our asset handbook last month, our ESG report. We're really setting ourselves up to be a sustainable business that can easily access capital from the largest institutions in the world, because we do tick all the boxes in terms of our expertise, the transparency of our reporting, our ESG practices, our capital allocation practices. We're quite transparent about all of those, and returning capital to shareholders regularly.
You raise a very good point about your business being scalable. And when Gold Royalty was IPO'd, it only had 18 royalties. Now you have over 200, many of which came from M&A. Will you continue to acquire smaller royalty companies if it makes sense to do so from a valuation point of view?
Well, it's hard to predict. M&A is a tricky art more than it is a science. And Ian Telfer, who's the chair of my advisory board, often says to me, deals are done by people, not by companies. And it really depends on the chemistry between the companies and the windows of opportunity that open and close to make M&A happen. But what I'd say, inevitably what will happen is there will be continued consolidation in the royalty space. Since we came on the scene and we instigated the whole consolidation theme in the royalty sector, and by buying 3 companies in 2021, we've seen 8 companies in total disappear from the royalty sector, including Mavericks and Nomad and the arms of other peer companies as well. But there have been a number of other companies that have disappeared and been transacted upon. It's inevitable that the 8 or 10 names that remain will probably end up consolidating to 1 or 2 mid-tier champions, because that's really what's absent in the sector right now. Is there's 2 clear categories within the royalty sector. There's the category killers, the large caps in Franco, Wheaton, and Royal Gold, and then there's everybody else that I would characterize as relatively small cap. And certainly a Cisco and Triple Flag have made meaningful steps to trying to capture that mid-tier mantle, if you will. But there's still quite a bit of room to grow to get to that $5 to $10 billion market cap range where you're institutionally relevant. You're big enough to be and liquid enough to be relevant to institutions, but still small enough to grow, because as good as those large cap companies are in Franco, Wheaton, and Royal, and they are tremendous companies, it's very hard to grow off of a base that large. And that's what the smaller cap and emerging mid-tier companies can offer investors, is the potential to grow dramatically and capture a mid-tier growth multiple, if you will, that hopefully will be superior to what the seniors are already getting in terms of their multiples to net asset value.
David, before we wrap up, I want to get your views on M&A. You were the CEO of Gold Corp, which was acquired by Newmont in 2019. Newmont is in the process of acquiring Newcrest. Earlier this year, Agnico and Pan American acquired Yamana. Is M&A going to continue at this torrid pace?
Inevitably. And, if you can't find it in the ground, you're going to have to buy it. And, we've seen reserves decline 40% from their peak in 2012. The industry simply has not reinvested in exploration and mine development. And that's been driven by, I think, principally by the fact that juniors have not had access to the capital markets consistently over a long period of time. It's almost been a nuclear winter, really, since about 2012. We've had periods in small, short windows where juniors have gone to the market, raised a bit of capital, but then it's shut quickly. And so the lack of that investment by capital markets and exploration, and the juniors, make no mistake about it, do all the heavy lifting on grassroots exploration. The seniors simply don't do that. They do brownfield exploration, but they don't do grassroots. The reserves are inevitably declining, and that downward trajectory is going to continue for the foreseeable future. So what are producers left to do but cannibalize themselves, right? If you're not finding in the ground, you're going to have to buy your competitors. And it's telling that, 4 short years after Gary Goldberg and I engineered the Newmont Goldcorp merger, thinking that set up the new Newmont for 6 million ounces of production for the next 20 years, they've had to go and do Newcrest because they couldn't sustain that 6 million ounces. Because the sector's shrinking, they're shrinking, everybody's shrinking, and they're going to have to eat each other up. And I would say there's a tier within the producer space, I would say kind of orphaned mid-tiers, that are finding it difficult to grow, and they're having to sell themselves. That's why Yamana disappeared recently. I think Peter realized it was difficult for him to grow. He wasn't getting the kind of currency he needed to grow. And I think there's a number of other companies of that kind of scale that are kind of caught in between. They're not really big enough to attract capital, and they're too small to really grow and have the currency to grow their business appreciably. I think they get taken out. I think the single asset producers or single asset companies get taken out just because of the existential necessity of the seniors to replace their depleting reserves and production. So I do think eventually M&A will exhaust itself, but I still think there are quite a few names to be taken out in the space to create companies of critical mass to attract that generalist capital back into the sector.
Very interesting points. David, as we wrap up, what can investors expect in terms of news flow from Gold Royalty in the coming months?
Well, look, we own our royalties outright. There will be no drama. We just have to wait and harvest the returns from all of the investments we've made over the last several years since our IPO. We own those royalties outright. We have well-capitalized partners that are driving forward those principal assets that you and I were talking about earlier on. They're well advanced in their development. So really the 60% compounded annual growth in revenue is just a function of time. And we feel quite certain that we'll be able to achieve that growth simply because our operating partners advance those projects so capably. They have the balance sheet to do so, and they have the technical capacity to do so as well. So we're very fortunate. We're in the best jurisdictions of the world with the best operators and some of the best assets.
David, that was a great update and a great overview of Gold Royalty. I want to thank you for being with us today, and I look forward to an update in the future.
Thanks very much, Jimmy.